Well, welcome everyone. Today's webinar is how COVID has affected the 1031 exchange. We will be going through, we got an extension, we'll be going through the extension just briefly because it's really not that detailed and we're expecting more. The industry, all of us in it are working to get further clarification and more time for things, but who knows, we'll see what happens the next couple of weeks on this whole thing. But we're going to go through those changes. We're going to talk about basics of the exchange. We're going to talk about what we're seeing in this in our space right now, and some of the things just to be aware of. So I think the continued damage after this thing, if we get back to work, is just going to be the financing component. So we've got to be aware of that. And with that, I guess my biggest comment is talk to the finance people. Have your people get pre-qualified before you get going on things. But some housekeeping. We've got a menu off the right side of your screen, and it's got a section on questions. So if you've got questions, please fill them out there. If we have time today, I'll get to them. Otherwise, we'll be addressing those via email after the fact. But my name's David Moore. I'm with Equity Advantage, and we're blessed to have this presentation with CAB. And we've got a great turnout. We've got, I think, of like roughly 120 people out there, so it's great. And hopefully you guys are all going to get something out of it. We like to say little nuggets of knowledge. If you would like CE, please reach out. The last frame in the presentation has an email address for Celia, CC Moore, and it's just cmoore@1031exchange.com. If you'd like CE for this, if you're an Oregon broker, please let us know. If you're from Washington, unfortunately, it's not 3 hours long, although I could keep talking, I guess, that long, but I know you guys are all busy. So right now we're talking about Oregon brokers, Oregon CE. If you're in a different state, please let us know. Reach out to CC once again, and maybe we can issue some credit for you. But like I said, we've got an hour here, and we're going to talk about how to move forward with this stuff. We are going to talk a little bit about some opportunities using IRA 401k funds to bail out properties, or maybe some other opportunities, maybe to add some cash to an acquisition, and actually phase 2 of a 1031 exchange even too. But once again, we'll get started right now. And I'm David, and thank you for joining us today. So we'll get the presentation queued up, and we're off to the races. So I guess the one thing I'd like to say is we've been through this before, and as far as Equity Advantage is concerned, we did have our sales marketing people out, but all our admin people are in. We've got sales people that can address any questions you've got. So we're actually running pretty close to 100%, but give us a little bit of time. If things get hung up on something, you got something specific, don't hesitate to reach out, give us a call. And it's a crazy time, and people are distracted. And this morning already, it's 10 o'clock, but we already got a transaction this morning that's closing today. So people are wanting to do stuff, and I think from what I'm hearing, the biggest issue out there is going to be just the inventory going forward. So the extension, we kept waiting, and understand that my background in the 1031 world goes back more than 30 years in application, but as a facilitator, 91, and we've been through this stuff before. We'd never had an extension for any reason for 1031 purposes until 9/11 happened. And when that happened, things changed, and now anytime we've got a presidentially declared national disaster, we have extensions issued. And typically they're geographically limited. You've got to prove that either your exchange was impacted by the event, or your accommodator was. Something had to actually directly impact you. And like I said, they're geographically limited. And in this situation, we've got a national extension. So the problem is that it's a very short one. And really, it just talks about, notice 2020-23 extends any 45 or 180 day deadline to basically July 15th if you're impacted by this thing. And we've got this page here is just a chart. The extensions talk about, take a look at it. If you've got people who had closings in these periods of time, you can talk to them about it, get the information out to them. If you've got questions or concerns, even if you're working with someone else, like I said, we're in here, we're ready to answer your questions. So give us a call. We'll get you taken care of, even if your client or you are working with somebody else at this point in time. This is what the extension does, and we've got one page that talks about some examples of the application. I'm really not interested in going over this at this point in time, but if you've got questions on it, give us a call. As I said, pretty much everybody in our industry is working to get this thing extended. The Federation Exchange Accommodators is really pushing for further clarification on this, and we want those extensions. I'm not going to talk about a potential extension because, hey, people are getting back to work. I don't want to give people false hope. And every time we talk about something like that, people start assuming, hey, they call every day. When's it going to happen? When's it going to happen? Is it going to help me? And we just don't know. So like I said, the initial extension really didn't do anything near what we anticipated it would. It's a very limited application, and you've got details in this presentation. One other comment, we will be sending the PowerPoint out to everybody that's signed up. And so you'll have this paperwork in place. If you want something directly on just the extension, we've got a one-page flyer that talks about all of it and who's impacted by it. I'm more interested in helping you guys get back to work, get people going where they need to go, and we're going to talk about what we're seeing as problems and concerns at this point in time, and how to overcome those. Think about this, okay? We're talking about why real estate, why today, and I always joke that I feel like, especially when I'm working in the IRA capacity, I feel like I'm selling real estate to real estate people, and it's sort of funny that I feel that way, but it's sort of true. And we all hear ads on gold and silver, and we hear the ads on flipping properties. And if we're looking at gold and silver things, I mean, you're seeing that on TV, you're hearing it on the radio, you're seeing it in print. And really, what are they selling? They're selling a tangible asset. And what's a tangible asset? An inflationary hedge. And let me throw this out. If you look at the bottom of this screen, right in the middle, it says real estate is a real investment. What is, and think about everybody, pretty much on the call is dealing with investment or commercial property, and you start looking at what that is considered. And in the investment world, real estate's considered an alternative investment, which absolutely drives me crazy. Why does Wall Street, why is a synthetic derivative, the thing that caused the last crash, considered a legit investment, a real investment? And yet real estate, as is gold and silver, the oldest investments known to mankind, are considered alternative investments, and inherently they sound a little bit more risky. And nothing could be further from the truth. So we look at real estate. I was always taught never to bank on appreciation, but hey, the bottom line is it's going to come over time. And it's great. It doesn't have to go up to make you money. You've got the cash flow leverage, interest deductions, mortgage pay down, depreciation, appreciation. At the end of the day, you've got long-term capital gains tax consequences, or you do an exchange and kick the ball down the road. So it's a pretty wonderful thing to have. For gold or silver or palladium, any of those things to make you money, they've got to go up. And then you've got to look at the loads on those things and understand it's got to go up a lot to overcome just the cost of selling those things. So, I love real estate. Everybody out there listening to this thing, watching it right now, you're involved with real estate in some capacity. And I just like to say, anytime I'm speaking about it, it's a real investment, not an alternative investment. And it's got so many positive qualities. These are just a few. But when we have recessionary periods of time, and I'm not saying we are in a recession or going into one, I don't want anybody mad at me, but the bottom line is, when you start looking at you need a flight of quality, you're going to look at a situation where you've got cash is king and everything else in this situation. So that's why real estate today. I will make this comment. What we are seeing, and if you look at just look at the Northwest, look at Washington State, look at California, look at what or Washington, Oregon, California, look at what the politicians are doing, and look at how that's impacting those properties. I've got so many clients calling up saying, look, the governors are telling my client or my tenants that they don't have to pay, and nobody's giving me any relief. So we've got people that are having some real difficulties here just because of what the government's doing in these things. And we've got a couple different opportunities maybe to rescue properties that we've used before. The benefit of having been in the business for almost 30 years and we're not talking 30 years aggregate, we're talking me 30 years, that we've been through these things and we know understand how to work forward on it. When we went into this crash that last time, we had a couple years earlier, we just put the retirement side of the business together, but we got involved with a lot of bailouts during that period of time, saving properties. At the end of this presentation, we're going to go through some examples, and one of them is really saving a property that was underwater. And in that point in time, understand that not only were the properties, people losing properties, foreclosure and all, but we had banks that were going away too. So we had to have an example in there of saving a property that ultimately became a multifamily project by using retirement money. We'll go into some of the details on that too. This slide, if you're in commercial real estate, you're probably going, David, why the heck are you showing me this slide? What do I care about Section 121? Those of you that are out there in the residential side, you work on 1031s on part of the time, not all the time. But this slide is a great slide, because what I want to say is just because you think something's an investment doesn't mean it has to be, and just because you think something's a residence, it doesn't have to be. And there's really situations to go back and forth. And if you're in the commercial world, understand you've got somebody that's done well, you've got a lot of properties, they've got a nice portfolio of property, they probably have a pretty nice home also. And understand Section 121 came into play in 1997. A $250,000 exclusion on the sale of a home for an individual and a $500,000 exclusion on gain meant something in those days. Think about it today. Think about how many of your clients, or you possibly yourself, may have gains way, way, way beyond the 250 or 500, and you think you're trapped. Well, easy solution: move out of the property, season it as an investment, and then maybe after a year's time, it wouldn't have to be rented, but it's just got to be held as an investment. Maybe you do the cash out refi, go forward into a new home at that point, but then you season it as an investment property, and then you can go someplace else into the commercial world with it. And then you're still entitled to 250 or 500 exclusion as long as you sell within 3 years of moving out of it. So that's a huge opportunity. We have people going back and forth all the time. On the other hand, we've got people in the 1031 world giving up properties. They're tired of the tenant rights, and they're just done, and they might want to go buy a place at the beach to retire into. That's possible too. Just buy the thing through the exchange, hold it for a period of time, and then convert it into a residence. There's not going to be any tax consequence. There are rules that come into play in that situation. The Housing Assistance Tax Act, for example, of 2008 talks about conversion and puts in timelines. You just can't buy a property via 1031 and sell it within 5 years after, with a conversion, because it'd be a fully taxable sale. You've got some other restrictions too. Give us a call if you've got somebody in that situation, you've got questions on it. But this slide, I just want to put out there, we talk about up to 64% of the properties on the market could or should be exchanged. Obviously any income property, but we start talking about dirt, we talk about homes with gains well in excess of 250, 500, converting those things. We look at partial transactions, but you've got a lot of situations where pretty much anytime you sell a house, you've got to look at these two things. The only things that fall in between are dealer properties and maybe Section 1033, where you've got involuntary conversion. And I'm going to tell you, anytime we've got the opportunity to use 1033 instead of 1031, we will, even though it means I don't do an exchange for you. Just want to make sure everybody's got the best instrument, the best tool moving forward in what they want to do. By the way, I had a hard time figuring out what I wanted to present in this thing, because in an hour's time it gets tough, and I know most of you out there have done many exchanges, and I really didn't want to bore you with the details of that stuff. I really wanted to present more information on using the tools that are there to get people where they want to go. This slide just talks about seasoning periods, and I think this is one of the biggest misunderstood topics in the 1031 world. Is I get these comments all the time. Oh, you have to hold a property 2 years. You have to hold a property 3 years. The bottom line is, if you're talking about investment properties, there's absolutely no stated black and white required hold. Now, I think 1 year you can justify for a couple reasons. One, it's been proposed several times. Two, you've got the break between short and long-term tax rates on assets held for investment. But you're looking at this slide, a court case where an asset was acquired via 1031, held for 4 months and converted into a primary residence. The people were audited, taken to court, and they actually prevailed in court. So, you look at these things, and anytime the typical response is, oh, the code says 2 years. Well, the code says 2 years if it's a related party transaction, and even with a related party transaction, it's not an absolute 2 years. Also, keep in mind your accommodator, facilitator, intermediary is not supposed to be giving tax or legal advice. The tax and legal advice is for your tax and legal people, professionals. So what typically will happen if you've got a question we know the answer to, we're going to get you the information, we're going to tell you to go talk to your tax people and figure it out. But I would invite any of you anytime, if you've got questions, concerns, some difficulty, give us a call. People want to hide behind their keyboards, and that just means a lot of correspondence back and forth, and a phone call can solve a lot of problems in a very, very quick time. It's a moving conversation. So don't hesitate to give a jingle, and we'll be happy to help you out. But time in and of itself is not going to dictate whether something qualifies. Now, you might be thinking, well, what about dealer properties? Dealer properties, different situation because your intent. So don't look at the time, look at your intent. Look at what happens there. And when you're buying something, what's your intent when you buy that thing? What are you doing with it? Now, if all you're doing is buying, fixing, turning, that's a dealer status issue. There's a court case, the Clarkowski court case, 9 points that are used to determine dealer status. I love that court case. I use that court case for 1031 purposes all the time. I also use it for our IRA 401k clients when we're looking at situations where we might be subject to unrelated business taxable income on a given investment. So, we're looking at a situation when we're looking at qualified money. Even if you have a Roth IRA, you're going to have tax exposure if you're flipping property with that retirement account, because it's not an investment, it's a business, and that changes the nature of it. Doesn't mean you can or can't do it. It just means it's another consideration and some tax exposure you may have. But like I said, time in and of itself is not the issue. You might have sold somebody a property 2 months ago and the world was rosy. I mean, it was a great thing. I mean, I can't believe we had the big evening of excellence in commercial real estate. That just seems like it was just yesterday, and here the world was a different place that night, and here we are in a whole different space. But you look at things, you might have had somebody buy something a couple months ago, and the hardships of today's situation have totally changed their situation, and they need to give it up. And I'm going to tell you, they need to talk to their tax people about it, but their intent was to hold. This may be an opportunity or a situation where they need to get rid of it and exchange into something else. And I'm going to tell you that's possible. So it's not the time, it's what you do with the property during the time you own it. That's going to dictate what's happening. And back that whole period too. If you've got a situation where maybe you bought a property and you got an unsolicited offer that was too good to pass up, maybe you take advantage of that opportunity. Don't let that become a pattern, because if it's a one-time deal you can probably justify, you start establishing a pattern, there's just no way to defend that, and that turns you into that dealer situation. So don't look at time as an issue, and events like this are going to cause changes. They're going to cause people to be in different situations than they thought they might be, and that definitely can impact their desired hold. And I just want to get it out there to people that there's absolutely no black and white required hold in the code. And as I said earlier, even with a related party transaction, if we can document there was no intent to avoid tax, even in that situation, that 2-year required hold would not apply if you can document there was no intent to avoid the tax. So don't let time be the issue, intent, and take care of it. I do sort of laugh because once in a while I have somebody say, well, I'm going to put in the purchase sale agreement that my intent on this property is to hold as an investment. I sort of feel like, well, that's a little bit of a guilty conscience, so I wouldn't necessarily do that. But you look at what you do, and even if you're a dealer, you can have investment property, you can have dealer property. So every time you sell, pay tax on something, it's going to justify the time that you don't doing the exchange. So what kind of property is qualifying for 1031? Now, everybody out there is probably aware we lost personal property transactions a few years back with tax reform. So when we look at this page, dealer property, Dealer property in and of itself is not going to qualify for 1031. Flippers, I'm going to say that's dealer property. A primary residence, maybe. I mean, how can you say it's not? Think about a primary residence where you've got the house and you've got some land. Maybe you've got a situation where, you know, you guys are all working from home a lot right now. Do you have a home office? Do you treat it as such? If you sell your home, you're going to have allocations. You're going to have one sale with allocations residential and allocations 1031. So look at what you've got, understand what's going on there, and we can have a single asset with allocations different directions. So you might have a farmhouse with working land. The working land's going to go 1031, the farmhouse going 121. You might have a multifamily project, not a project, but let's say it's a duplex, fourplex, something like that, where one unit's owner occupied. Same situation's going to apply there. You know, like I said, you've got a situation where you've got 121 and 1031 to work with in different scenarios, and use them both. But in that primary residence portion, if you've got somebody that's got gains way beyond the 250 or 500, maybe we look at, you know, piecing things off, converting the asset, that type of thing. Or you've got a portion of the home that might be taken and used 1031 on. So even a primary residence, 1031 can apply. Personal property, as I said, is gone. Partnership interests are specifically prohibited from 1031 treatment. So that's why we like TICs, okay? Tenancy in common is the way we're going to own properties if we've got a group of people and they want to go different directions. If you want the liability protection the LLC offers, you could have a series of limited liability companies, tenancy in common. Worst case, if you've got a single limited liability company, we're going to talk briefly about partnerships. There's a page on it, but we'll have to talk about what we do with those things. But understand, once, and I don't know why, it seems like for years I haven't had any transactions with C Corps and S Corps, but in the last 2 weeks we've got a series of them coming in, and every time we deal with one of these, it's just a prime reason of, you know, example of why you don't own property in a corporation. Just getting it out of the asset, just getting the asset out of the corporation is going to trigger tax problems for people. So it's really cumbersome and problematic. You know, if you got somebody in that situation, that's a whole nother conversation. Vacation homes. Well, define property held for investment. As we said, we've got no required minimum hold on things, but vacation homes, we've done transactions, you know, since we started the company on vacation homes. And I did see, you know, my friend Dennis down at the coast is signed up today. You know, you do a bunch of stuff down there. We've done a bunch with you through the years, and you know, you've got a situation where second homes finally got guidance a few years back, and with a second home, we got restricted use of that property for the 2 years pre-disposition, the 2 years after acquisition. So second homes can be used through the exchange, but the rules are much, much tighter than property that are primarily or just treated as investment properties. Because, as I said, you've got to restrict that personal use of the property for the 2 years preceding disposition. You're restricted to 2 weeks or 10% of the time it's rented for the 2 years preceding and 2 years post-exchange. So, you know, I'm going to throw you back into that scenario where, you know, define property held for investment, understanding the timelines that are there. If you just stop using the property entirely, is it now a second home or is it an investment? And if it's an investment, you know, can you use a much shorter period of time to get things done? And I would put out there that yes, that's possible. So any of those things, you look at those questions, think about what it is, think about your ability to move things back and forth. But the bottom line is an exchange is just conduit out of what you don't want into what you do want, keeping your money, you know, tax deferred. And unlike a retirement account where, you know, like I said, I work with retirement accounts professionally through IRA Advantage, and most of all our clients are going into real estate and different things. But, you know, with that said, I'm not a huge fan of IRAs or 401k plans because I just feel like they restrict your ability to do stuff so much that they can become cumbersome. And at the end of the day, understand you're paying normal income tax on the distribution at the end of the day, where, you know, something where you're pulling money out of your pocket, you know, like I said before, you've got the ability to, worst case, you're paying long-term capital gains tax consequences. Best case, you swap till you drop. So you can entirely get rid of any tax consequence by doing that. Anyway, so with that said, onward. I like simple. So once again, most everybody in the audience has done exchanges many times, and I'm not going to go through all the basics of the process, but bottom line, 4 things that I think are important. These are my 4 cornerstones. 1, it's got to be an exchange. Something's given away, something's received. And that transaction is between the taxpayer and the exchange company. It's not between the taxpayer and anyone else unless we're doing a true swap. But in today's world, we're looking at 3-way accommodated transactions. And the taxpayer is just selling an asset, they're buying an asset, we're stepping in the middle of the transaction through that assignment agreement, turning it into an exchange. 2, what's relinquished and received must be of like kind, refers to the nature of the investment rather than the form. So as we stand today, and every few years the government tries to change this a little bit, but as we stand today, it refers to the nature rather than form, meaning you can go from a rental house into land, apartment buildings, office buildings, strip mall. It doesn't really matter. You're giving up property you've held for investment, you're acquiring real property with the intent to hold it for investment. Once again, if the nature of that transaction shifts after acquisition, that can be fine. It's just a discussion you want to have. And by the way, we're just one member of a successful team of people here. You want to have good, competent tax and legal people involved, people that you're paying for an opinion of something, not paying to learn on your behalf. And you want to use those people, especially your tax people. I think they're critical for anyone that's got real estate. And you want to use these people before April 14th. Make sure you talk to them early, talk to them when you think you're doing things, and let's rationalize these decisions, and let's not make the exchange at the 11th hour the thing that has to happen because you just found out you had a gain. So look at those things. We're going to have good, competent tax and legal people. I think if we're looking at property, Multnomah County or Oregon, for example, these days, any of these rent control situations, California, Washington, you better have management too these days. I mean, I think you got to have somebody there to help you, protect you from liability. The management companies are probably going to get busier and busier because it's just such a complicated process. You look at the CARES Act, and there's different things that are coming out, and all the rent control stuff, and it's really getting cumbersome. And it's something, the Multifamily Housing Association has got to be so busy with research and advice and everything else. But use those people out there to make sure you're getting where you need to be on things. It's not new, 1031. So that first, it's got to be an exchange. Something's given to us, something's given back. These next 4 pages talk about those 4 cornerstones. So it's got to be an exchange, got to be like kind. I'm going to finish my 4 cornerstones just by going through these slides. So like kind, nature rather than form. We're looking at the NAPKIN test now, and that talks about the value and equity requirements of the exchange. I hear people talk about another big fallacy of the process is debt, okay? And anytime we have a situation like we're having right now, what happens? We haven't seen the property value erode yet, and hopefully we won't. But we're in a situation where the LTVs have changed, the cost of money's gone up, sort of really drives me absolutely crazy. Fed drops the rate 1.5, and what happens? The borrowing rate goes up too. The biggest issue is impounding of funds for the acquisition of stuff. That's what I'm seeing right now. But I hear people say all the time, you got to replace debt in exchange. And last time we had the crash, we're looking at the same situation. People are saying, well, they talked to their lender, they've got a decreased LTV, the property's value had gone down, reducing the equity. So they were in a bad situation because here they need a transaction where they're either going to have to add cash to the transaction to take care of that decreased LTV, or they're going to have tax exposure. So when we look at value and equity requirements of the exchange, that's what's important. People talk about having to replace debt. Not true. Debt can go away 2 ways. One is by going down in value, which triggers tax because you went down in value. The other way debt's going to go away is by adding cash. You can always add cash. You just can't receive cash. So we like to say, if you look at that bold print statement at the bottom, boot is unlike property received in exchange. Cash, personal property, or reduction in the mortgage owed after an exchange are all potentially boot and subject to tax. But the sentence above says you may offset mortgage boot with cash. You cannot offset cash boot with additional mortgage. So you can always add money. You just can't pull it out without tax. Now, if you don't fully meet those requirements, understand 1031 is not all or nothing. So you might have clients right now that want to pull some money out, go do something else, and that's fine. They can pull the money out, go take it, and they're just going to pay tax on the money that comes out. They're going to defer the balance of that money, or the gain, I'm sorry. Continuity of vesting. Time is the biggest headache. Vesting is the next. And investing just comes up so often. If we're looking at Oregon, for example, we're not a community property state, so even a husband and wife going in and out of an LLC is a problem. Now, once again, what are we potentially looking at? And this is why you want to get your people pre-approved as soon as possible, because if they haven't sold yet, and number one, get them out there looking for the replacement before it goes away, get them pre-qualified, understand what's going on. But I've had people quit their jobs in the middle of the transaction. That's something that's just a bad idea, obviously, if they need to finance something. But in a market like we're in, we're going to have people that have lost jobs. We're already seeing this. We have people lose jobs. They need to go out and get financing on the purchase, so maybe they have to add a spouse. And we've got to look at a situation where how do we do that? And basically, if somebody's been married for years, they file jointly, even the property's not in their name. Maybe you talk to your tax people, you do a correction deed, because if you're filing jointly, you've been married years, even though you're not on title, you've been enjoying the benefits and burdens of ownership. So understand that that deed doesn't necessarily reflect ownership of an asset. If I sell to you on a land sale contract, I have title till you pay me off, yet you own the asset. So you can fix those things up. You need to look at what's happening. You might have a situation where you're pulling a preliminary title report, get that trio on an asset you're going to sell. You figure out what's going on, and you see somebody on title that you didn't think was on title, or maybe title's not really accurate, so you're doing those correction deeds to fix it. But this is something you need to look at before you sell, not when you're going to finance a purchase on the replacement, because understand that the loans these days, things get kicked out of the pipeline, and then you got issues getting them back in, timelines get stretched and everything else. So the biggest piece of advice I've got is, get people into that pipeline working forward sooner rather than later, and then we can address any, issues that might be there. And as I said, 1031 is not all or nothing. So if somebody wants to pull some money out, they can pull it out either at close or after they've received everything they have the right to buy. So the timelines of 45-180, property identification. We're not going to really get into this much other than to say each of these three rules are working independently of each other. And in a nutshell, 3 property rule, 200% rule, 95% rule. And when you're talking values, in 1991, I was going through an audit manual, and one of the questions they had in that thing was the property listed at time of acquisition? So let me put this out here. Does a property have to be listed to be identified? And the answer to that is absolutely no. Does a property have to be listed to be acquired? No, it doesn't have to. But you need to give what the government would deem an unambiguous description. You've got to receive substantially the same thing. And we're going to talk about some issues where there are some time periods and issues where that comes up. This slide, when can I get my money? This is something that is really important to understand, because about, I don't know, a little over a decade ago, I guess, the government clarified their position on this thing. But we're in a market like we're in right now. I know that people are going to be calling up. They're going to be wanting to terminate a transaction, get access to the money. And one other comment, back to the extensions that were put in place. They're elective. They're not mandatory. So understand that you don't have to work within those extensions. If they apply to you, you still have the ability to work with your initial timelines, which comes back to this slide, because you don't want to, if you want money out of the transaction, you don't want your ID or 180th day periods extended. You want to work with the old ones. And the reason that's so important is you can only receive money out of an exchange when you satisfy the 1031 G6 rules. And basically they state you can only get the money after you've received all property you have the ability to acquire, which means at no time prior to the 45th day, and only after the 45th day after you've acquired everything you have the right to buy. So when you're getting to that 45th day, if you've got a client getting that way, they've got to be committed. They're all in or all out at that point, because if they ID property just in case, and you think about this is a problem with the opportunity zone situation too, because OZs have 180 days too. And if we've got somebody that's ID'd properties just in case, and they come back later, they want to jump in the OZ, we can't give them the money till the 181st day. So look at that situation. Understand when you're, reaching that 45th day, if you've ID'd stuff and you decide you don't want to go forward, rescind the identification on day 46. We can get you the money. If you are sitting there at that 46th day or 45th day, and think about this too, you as a broker, you might find them something after that date. They just ID'd things with the idea they might want to do it. And now you find them the ideal property and you want to get it done. We can't give you the money. So this page on when I can get my money is critical for everybody to understand. And it goes out in every packet that we put out. Both when we're starting a transaction, people initial it at the bottom, and then with the idea talks about it too. But you may or may not be surprised at how often this comes up. And even though they've got a signature at the bottom of a page, that they're wanting to get the money out, it's really a bad situation. It really puts us in a bad situation, puts the client in a bad situation. I wish our position prior to that ruling was, hey, if somebody wants to take the money, why not let them? I mean, it seems like the government would be happy with it. But what it does today, and this is why anybody in the exchange world that does this professionally, they're not going to let that money out unless those 1031 G6 rules are satisfied. Partnerships. Anybody working in the commercial investment world has had to deal with this. So we talked briefly about corporations. Corporations, you just don't want to use them. But when we're looking at limited liability companies, we're doing swap and drops, drop and swaps. And a drop and swap just means you're busting that entity into a typically predisposition. And the normal drill is you've negotiated a sale, escrow gets opened, escrow receives an addendum shifting the ownership, or the purchase sale agreement is going to be changed to reflect that the individuals are selling the buyer, and escrow's drawn a deed from that entity to the individuals, and the individuals are selling. And the whole question, that's when it 9 times out of 10 happens. The vulnerability is the individuals didn't hold the property for investment predisposition. So ideally you do it maybe a year in advance. But realistically, that just doesn't happen because nobody thought about it, nobody talked to us about it, and then you've got everything that needs to be done to successfully break that entity, and then the maintenance of that thing for the year predisposition. So we've had some good court cases in the last couple of years on this thing. Were much shorter periods. We had a court case where there was court-ordered liquidation of the limited liability company. Mother and son just couldn't get along, so sued each other, went to court. Judge says, hey, court order, you're immediately to liquidate the LLC and exchange out of its property. So of course we in the industry love stuff like that. The California Franchise Tax Board, which is one of the hardest core on this stuff. California's been problematic for a long time. Last summer at the FEA conference in New Orleans, they were there talking. They just don't want to see anything. So typically they don't want to see anything reflecting that prior ownership. So what they don't want to see a PSA being assigned from the LLC to the individuals and forward. They just they don't want to see anything giving them a reason to look further. So make sure if you're in California, you're writing those things from a deal and get the thing broken, get it taken care of before you're selling that asset. But I'm going to tell you, the earlier the better on that. I would encourage you to do it maybe a year predisposition, at least different tax years. But ultimately, it's not up to you, the broker. If you're the broker, it's up to the taxpayer and their tax and legal counsel. Current trends and issues. That's why you're on here. So, we talk about, when you want to incur tax consequences too. You've got situations where you can shift gains from one year to the next by entering into an exchange with a genuine intent of going forward. You've got situations now where people might be wanting to terminate the transaction, get access to money. You've got situations where people might want to pull some money out, as we said. And I'm going to tell you, it's got to be done. We cannot take the money and then give it to them. So if they want some money out, they know they want money out. They need to get it out at escrow, at close, and it's specifically excluded from our exchange agreement. So the exchange agreement, the assignment agreement is a partial, it's not full, and that allows the taxpayer to get it. You don't want to have the money get to the exchange company and then get it out, because then you're looking at the 1031 G6 rules, and that's probably not going to make people happy. Partial exchanges, like I said, look at it. If you look at somebody's basis on a transaction, every dollar they spend over the basis represents tax deferred gain. Once again, their basis is just what they paid for plus the capital improvements minus the depreciation. But understand the purchase price is going to be impacted dramatically by previous 1031 exchanges, or maybe the property was gifted to somebody. That's going to impact the person who receives the gift is going to have the same basis as the person granting it. If I pass away and my heirs get it, they got that stepped up basis. So we got to really understand that acquisition number isn't necessarily what they paid for it. Even Section 1034, if we go back pre-97, you had residential rollovers, and a lot of times people's first investment property is a home. So understand that first number varies depending on how they got the property. So you've got purchase price plus capital improvements. And I talk to people every day and I ask them, okay, during the time you owned it, did you do any work? Oh yeah, we did all these improvements, capital improvements. Okay, did you write them up? Oh yeah, we wrote off everything. Well, they expensed it. They didn't capitalize it. Capitalized items increases the basis. Expense items you're just writing off, they don't impact that basis. So it's really important to understand what's going on there. Also, I guess a very, very important note, depreciation. If the property is being rented out, it's got to be depreciated. So what happens if you didn't take depreciation? Well, the government's pretty clever with this. Basically, their attitude is you should have, therefore you did. So you're working with somebody that didn't take depreciation. If by law they were supposed to, they need to be aware they might be on the hook for it, even if they didn't get it. So it's really important. And once again, that's a primary reason you've got tax people involved. Partial exchanges, give it a shot. A lot of times people don't know what's going on. Maybe they don't know anything about the exchange and somebody told them at the 11th hour, hey, you got to do it. And they think, okay, I haven't been able to get a hold of my tax people because everyone's working at home. I don't know what my basis is. I don't know what my gain is. Well, maybe they just buy 45 days. We've got lots of people that do that. They're going to take 45 days to figure out what's out there. Maybe they're taking the 45 days to see if any further extensions are going to be issued, so on and so forth. But that's it. Give it a shot by the 45 days. Failed exchanges. That once again is a situation where we really, really have to stress that 45-day timeline, because if you've got a failed exchange, you want to get the money out, you got to be careful on that, right? So when do you want to get the money? What happens if you find something else? What happens if we do see erosion of prices and you want to just have that patient money? I mean, what's a golden rule in recessionary times? Those with the gold make the rules, and then you're going to have those opportunities. So that exchange, that has a timeline that's got to be met, maybe a situation where you've got the money, you had some tax consequence, not as bad as you want, but you just want to look at a situation, you want to have the capital ready when you want to go. That's what we're talking about with the failed transactions, your desire to just get out of it. Make sure you're really eyeing those timelines to get things taken care of. Moving on up or down, you've got people that are going to take advantage of the situation and go up. And on the other hand, I've got people that through this stuff, they want out. It's not the same. Our Wall Street clients are the ones, we've got lots of people that are just saying, hey, I've been through this too many times now. I want out. I want to go out and buy real estate or make loans, buy notes, that type of stuff. So we've got lots of people rolling out of the retirement accounts. Or the big opportunity really with the retirement account stuff right now is that people that have been, laid off, they've got access. So typically, if we're looking at 401k funds, if you're happily employed and it's a current plan and you're under 59 and a half, you're stuck. You can't get access to money till you're 59 and a half. Well, if you lost your job, you've got access to the money. So I'm going to suggest maybe you want to roll that money into an IRA instead of looking for that next job in the 401k plan for the next job. Keep the money out, get access to it. If you want to go out and buy some real estate or leverage into some hard assets, tangible assets, do it. This might be the opportunity to move that money out of those things. You've been stuck with it, and now you've got the opportunity to change. So, on the other hand, we've got people that are just tired of the rent control. They're done. They want out. So they might be going down in value. This morning, we've got somebody that we're dealing with 11th hour transaction, and it's closing today, as I said earlier. And what are they doing? California to Florida. Why? Well, California is a wonderful place to own a rental house, isn't it? So you're going from a blue state to a state that's much more conservative, and we're seeing that same thing happen all over. If you look at a map of this country, we've got lots of money moving to the places where the owners actually have some rights and they can do some stuff. So just keep in mind, that's what we're talking about, moving up, moving down, taking care of stuff. Combinations, IRAs and 1031s, 401k plans and 1031s, loan to values are decreasing, or maybe you want to go up, maybe you're buying up. Well, you can combine IRA 401k funds even with a 1031 exchange. Now understand the 1031 requires, if we look back on partnership transactions, drop and swap, swap and drops, all that stuff that we have to deal with, we've got issues there where we've got to look at the ownership of that item. So when we're looking at joint ownership of a property between an IRA and 1031, 1031 prohibits the application to a partnership. But if we're looking at combining IRA and 1031 money, we can do it two different ways. We can do it tenancy in common, which is what the 1031 is going to require anyway, or we can do it as common members of an LLC. Now, each has benefits and pitfalls. The LLC is nice because it's simple and everything just goes in and out of the LLC, and we just have an LLC with an IRA or a 401k plan and your personal money maybe. So we can do that all day long. And it makes it nice and easy. So when we're looking at qualified money, IRAs and 401k plans, you cannot transact between or for the benefit of a disqualified party, but you can transact along with. So who's a disqualified party? Well, you'd be a disqualified party to your plan, as would your parents, grandparents, kids, grandkids, their spouses, or any legal entity owned and controlling interest by one of those. But siblings, aunts, uncles, cousins, they're not. So that's a pretty wild thing. But when we're looking at these transactions, you can't transact between or for the benefit of, but you can transact along with. I like to see I like to see the tenancy in common structure, because that way the qualified money, when the property sells, can just go back in the plan, taking care of the natural tax deferral treatment it enjoys, and then you can 1031 your personal portion, and that works beautifully. You're just doing an exchange of the portion of the assets. The tax money is going forward via 1031. The qualified money goes back in the plan, and it's just a nice structure for joint ownership. I really like that, and that's something we seem to get involved with a lot during these crash periods also. So this is the page just talking about the LLCs and the TIC. And if you've got questions on this, don't hesitate, give us a call. We can talk you through these things and figure it out and hopefully get you taken care of. A few examples and we're done. All right. So you have to look at what's going on out there, and you have to understand that with hardship, a lot of times, or with these changes bring opportunities. And one of the opportunities that's out there is coming back to the retirement account. So think of a reverse exchange, and think of the biggest problem with a reverse exchange a lot of times is people's access to money to get the deal done without receiving the funds from the property that's in the future to be disposed. And so we've got a situation now where you can take up to 100K out for up to 3 years from the retirement account. So I'm going to put it out there that might give people the ability to go out and do that reverse exchange, or it might help them with the funds necessary to do that reverse exchange, and it'll take care of that situation. The other thing that we do regularly is with retirement accounts, you've got a 60-day rollover, like with an IRA, that you can take once a year. So we have historically done many reverse exchanges with people pulling funds out of their retirement account for that period of time to get the purchase done. When that sale property comes in, the funds come in, we're going to use the sale proceeds to repay that retirement account. So we do have, it's a tight timeline. It's only 60 days, but I'm going to throw it out there to you that this is something that we do regularly, and it works very well. So if you've got a client that is in a reverse, that they see an opportunity, number one rule for me with reverses is always ask for the time that you feel you can get. Don't go with the reverse as the first choice, go with it as a fallback. So if you've got a situation, a client comes to you, they find that perfect property because somebody wants out through this period of time, go ahead, make the offer, ask for whatever time you can to do it as a delayed exchange. If the purchase has to happen and the sale hasn't occurred yet, maybe you get to that point, maybe you can buy a little bit more time. If you can't do that, then we do the reverse. And I'm just going to put it out there once again that maybe use that up to the 100K or use the 60-day rollover. Either one of those is going to give you access to money to get a deal done today. I just looked at these solution pages. I got these slides, like I said, I wasn't sure what I was going to put in here, and I just realized I'm looking at, solution 1, solution 4, they're all wrong. Sorry about that, everybody out there, but hey, at least I put a little smile on your face. This is an example that is something that all these examples are actually real. All these examples have been done. So this one talks about a builder developer that had a piece of land, and this was the last crash. It was roughly a $3 million property, and he called us up because he was worried he was going to have it foreclosed, and he, the hardship was he'd had it, he was ready to go build on it, but he had problems. Obviously, that last crash really wiped out a lot of people. I'm sure everybody on this call was impacted by it. So in this situation, he just called up with a little bit of hope and said, hey, is there anything I can do about this? And so his father happened to have a nice chunk of capital in his retirement account, a couple $1 million. And so this $3 million property had $1.8 million lien on it. Not only he was behind, but he didn't want to lose the thing, and the bank was failing also. So we had a timeline that had to be met. So what we did in this situation is we did a checkbook IRA for his dad and moved all his money into the new checkbook IRA LLC. And then we created a second limited liability company. Junior, the property owner, the developer, he contributed the property to the limited liability company and received the membership interest attributable to the equity in the property. Now you have to have a hard valuation done on that dirt so you can defend what's going on there. But he received a $1.8 million interest in that property because that's what the equity was in that dirt at that time, and it was true equity. At the same time, and this is critical, at the same time that was happening, Dad's checkbook IRA wrote a check into that limited liability company as well. So now you've got a new limited liability company that has two members. The son, via the property that was contributed, so he received the interest attributable to equity, and the father's checkbook IRA LLC, which receives membership interest attributable to cash contribution. The great thing is the LLC owns the asset, the LLC has the cash to pay the property off. We couldn't just take Dad's IRA to pay the property off directly because that would constitute a prohibited transaction. It's a benefit to a disqualified party. By using this solution, we saved the property. Ultimately, the property was developed into a new multifamily project and they got it done. But bottom line is, this is one example, and we did this over and over again. This is one example of a situation where the taxpayer, the property owner, was going to lose an asset. We bailed them out, and they have it to go forward and do what they want when they have that opportunity to make it happen. And actually, one other comment on that slide too. We can do, we can do that on a variety of things. But if you want to just go out, maybe you've got a piece of property and you want to add cash, you want to do that same process to go build something. So you might have a property that you own, and you want to go build on it, use a retirement account. We can use the same structure to do that too. So we can use it to bail out properties. We can use it to take care of other opportunities going forward. This slide is interesting because this is an example, once again, that might be possible if people have access to 401k funds that they didn't previously have. in this situation, they're really, what we're doing is what's called a rollover business startup, and it's just an amazing opportunity for people, because what we're doing in this situation, this came about. Well, the last crash, we put our IRA business together to accommodate our real estate investors. And what happened right after that was we had that crash, and we had a whole bunch of business startups we've done. And when we use, this is called a rollover business startup, or ROBS. The acronym's sort of unfortunate, but the bottom line is, when you're looking at this stuff, we're in a situation where these people have had IRAs, and they came to us and said, look, we just want to take our IRAs, go out, buy this mobile home RV park. And we normally would have used what's called the checkbook IRA, as I previously mentioned. But in this situation, they talked to us later, and they said, well, gee, you know what, we want to live there, and we want to be the on-site managers. So we said, well, we can't do that with an IRA, but we'll use a rollover business startup. And what that means is we moved their respective, the two IRAs, they were retired. We took his and her IRAs, moved them into a new 401k plan. The 401k plan bought the corporation bought the park. And we have a situation where the investors received an investment, a job, and a place to live, all with this one process. We have used the ROBS process to do everything from this type of transaction to real estate investment companies, mattress companies, fishing. We had a charter fishing operations. We've done all kinds of different things with it. But this business situation, flipping properties, all that can work just fine. This is what we use to get those people where they go. And you can, once again, we require the taxpayer to have 5% of the capital going in. But this is a situation, you might have a client that's got a piece of property, they've been there forever, now they're going to lose the business some because they've been closed for the last month, they don't know when they're going to get back on their feet. Maybe the only money they have is their retirement account. So this is a solution for you in the commercial world to say, hey, look, if you've got an IRA, 401k, maybe we roll those funds into a rollover business startup, and that's going to be the way they save their property or the way they move forward with stuff. So it's important that you're aware of it and that you know it's out there. End games, okay? Swap till you drop. You might have people, like I said, saying, hey, we're done with this stuff. We're tired. We'd like to go away. And anytime we've got something, I like to see things that are catalyst to liquidity. We want to see movement. So end game, swap till you drop, exchange into a retirement residence, exchange until it makes tax sense. We've talked about those things. Exchange into passive investment, DSTs. So, think about DSTs. You may or may not be aware of them. You may or may not like them. It's Delaware Statutory Trust. They've pretty much taken over the institutional offerings were Tennessee and Common pre-crash. TICs still exist. TICs are typically used for value add situations. I talked to somebody yesterday that does a debt-free passive investment situation. They use TICs, and in their scenario, they don't have any debt, but they can accommodate pieces into some other stuff. But you might have people that are just done with the rentals. They want to get into something else. They don't want to pay the tax. Well, you can get into these DSTs or Tennessee and Common situations. Installment sales, structured sales, really both those work, and actually deferred sales trust. All three of those options sort of work on the installment sale model. But as an installment sale, you've got a person that's got to be involved, and you risk a foreclosure situation, maybe if the buyer defaults. Where a structured sale is an institutionalized installment sale. And what you're doing in that situation is assigning the obligation to pay to a third-party assignment company. Typically, it's a whole life company, and they're going to do that installment sale treatment for the period of time you want. So if you want to just close it to next year, shift it to next year, the gains, well, maybe you have a 12-month structured sale, or if you want it 10 years out, that's fine. My caution to people on installment sales of any form is, if it's a leveraged investment, if it's been depreciated, you're going to have tax exposure on depreciation recapture and debt relief in the year of the sale. So you better get enough down payment to take care of that tax obligation. And also, if you're a broker, you probably want to get paid. And if you're an escrow officer, you probably want to get paid too. So we need to make sure, I want to get paid, so we need to make sure enough money comes in on the down payment to take care of all the closing costs and any tax obligation is there. If it's unencumbered dirt, you're not going to have that issue, but be careful on it because that comes up. CRTs, charitable remainder trusts. That's another great option for people. I've got Tina Colson in my office, has worked in that space for many years. If you got questions on those, give us a call. We don't do them, but we've got sources to take care of that stuff. And then gifting, we've got lots of times people are just sort of looking at the opportunity. Maybe the kids have had a hard time and been evicted, or maybe they're not your situation where you want to help get them something. So we've got lots of times people will be buying properties, and think of this. You buy a property, you put it in a limited liability company. If you gift a property to somebody in its entirety, you gifted them all the equity in that thing. So you got to be really careful about gift tax limitations there. But if let's say we buy it and it's in an LLC, think about giving something in pieces. All right, if you gift somebody a minority interest, you transfer a minority interest in something, and we do this with distributions on retirement accounts all the time also. If you take as a distribution in the retirement world, or if you gift in the tax world a minority interest in something, it's possible to discount that value of that gift by up to 40%. So think of the tax savings in that situation. If you're moving, you can accelerate transfers while minimizing the tax consequence by giving things in kind. So whether that's a piece of property or a piece of something else, contemplate that. The reason I love the LLC is you're assigning a membership interest. You don't even have to change a deed. You can also deed a TIC interest in something, but every time you do that, you've got to have a new deed drawn. So just keep those in mind going forward. Our last page, once again, thank you so much for joining us today. I want to make sure if you'd like CE on this, you get the information to us. If you've got questions on this thing, please, don't hesitate to reach out. We will be addressing those. And, I want to make sure that, actually, I see two questions, so I'm going to address those real quickly. If you need to go, please feel free to sign off. We're into it, the hour. We're supposed to be wrapped up. Once again, got questions, reach out. If you need the CE, reach out, and we'll take care of those things. These are three of our sites. We've got you may or may not be aware, there's a post 1031 site for people that have a situation where they got questions. I see Cliff just wants to say thank you. Thank you very much, Cliff, for being part of it. Appreciate it. And so this question is, do you see a time when they do away with the absurd 45-day rule? I wish I did. The problem that we've had, every time they do it, every time they talk about doing it, they want to bundle it with something else. So the last time they proposed getting rid of the extensions, we ended up with a situation where they wanted a true like kind. So instead of nature rather than form, they wanted similar, service and use. I mean, and so it really was going to lock things down. I wish they'd get rid of the 45-day because it's the biggest problem we have, and it just puts good people in a bad spot. So at this point, I haven't heard anything about elimination of the 45 days. And it's really funny. I was talking to somebody yesterday because I've got brokers that will say, well, gee, I don't like the 45 days, but people procrastinate. So if we don't have the 45, they're just going to be screwing around making offers. And think about this. Everybody out there's probably heard the term buyers are liars. And the thing is, if you go back pre-1991, we didn't have a situation where you could ID a county, for example. So that's when the hard rules came into play. And we'd have people tie up a county. Well, imagine you're the broker. You've got a situation where all of a sudden you're trying to keep the thing under control. You got to know what property's been identified, and you want to know what order it is too. You want to make sure your property's number one. So if it got stretched out, you might have some issues there. That you got the procrastination issue. With all that said, I wish they'd get rid of the 45. Give us the 180, leave it alone at that, and take care of it. But people will procrastinate. So sorry I don't have any more on that, but that just sort of comes up. Cliff, I want to thank you. We've got Wade. Thank you very much. And it looks like that's, well, actually, I've got just another thank you from Tammy Garza. So thank you, everyone. Best of health to everybody, and look forward to a better, brighter future in the short period of time moving forward. Thank you very much, and all my best to you. Bye-bye.